Can this latest equity market rally be trusted? Hey, everybody. I'm Serge Berger, your host of the Steady Wealth podcast. Thank you for joining in on another episode. This one here a bit timely, and we want to have a look at individual parts of the market and their contribution to the rally and try to answer the question whether one can trust this rally going forward, whether this is going to be potentially a runaway train in the tech sector, in semiconductor stocks, more particularly, and what that would mean for asset allocators, for traders, for self-directed investors, all that kind of stuff. What we're going to do here today is, whether you're watching this on YouTube or on traditional spot podcast hubs, you will not miss a beat. I'm going to be looking at a few charts here. So if you're watching this on YouTube, you will see those charts. If not, I will just describe them to you just as well. So not to worry there one bit. We need to talk a little bit about seasonality. And one of the things that I want to make sure that I continue to be on the record for is that seasonality is one of those things that we have to respect, but we also need to be aware that seasonality can, if misread, can really lead to pretty catastrophic consequences from an asset allocation perspective and to drawdowns in portfolios. Let me start off by talking a little bit about seasonality. Now, there are lots of analysis out there that one can find that speak to the importance of seasonality. And I certainly agree that seasonality is important. Let's first talk about what it is. And truly, now, market seasonality is, and we're talking particularly equity market seasonality, is actually, if you go a little bit deeper rather than just looking at a historical chart of it, has a lot to do with flows coming into the market or out of the market. And those flows, and this is the important part here, need to be understood where they come from. These flows are typically in big institutional investors, be that pension funds or insurance companies. Those are some of the largest asset allocators in the world, either adding new capital, putting more capital to work out of the natural flow of money they receive, or making changes and getting out. That is, to a decent extent, it's of course not everything, is what it boils down to. So when we look at a seasonal pattern that I think a lot of people are aware of, because we also just came out of it, the end of the year, the November to December seasonal pattern in the S&P 500, again, this is specifically to the S&P 500, we see an undeniably bullish trend. And a lot of that has to do with the way people are positioning or have to position themselves. So there's some fear of missing out. I call it performance anxiety on the part of fund managers taking place. There's sometimes a little bit less liquidity. Sometimes we, believe it or not, we have the central banks play games and allow this rally and kind of add fuel to the fire. That, for example, is, according to our analysis, what happened last year as well. So in the fourth quarter of 2023. Of course, you have some natural inflows taking place of people looking to allocate money to round off the year. The opposite can happen in the beginning of the year, and this is where I'd like for this conversation to go here today, is to maybe be a bit careful here about trusting this rally too much in the broader market, although it really does look very bullish. So if you look at the bottom left-hand on the screen, and what I'm going to talk about here, again, if you can't see the screen, do not worry, I'll describe. The seasonality in January through about the middle part of March is much, much less decisively bullish, or bearish for that matter. What it is choppy. And where we tend to get a lot more fake outs, though. So typically the end of the year rallies or the seasonality in starting to take place at some point in late November, mid-October, late October, or into early November, we tend to see pretty little fake outs, not that many fake outs, meaning it's not a rally, then it completely falls apart and then it starts again. We tend to see a pretty clean-cut move in that. Now, it's not always like that. This year, it's going to be a bit different. We have an election, so we're going to be very careful about that fourth quarter seasonality come this year. We've got plenty of time between now and then to start talking about that. But the beginning of the year can be much trickier. And here's the reason why. So if you think about an institutional investor coming into the new year, they are probably not going to sit down on January 3rd, 4th, or whatever the first trading day of the year is that year and start just pounding out positions, like either adding or out or selling. They will come back. They will take a week or two to have meetings to decide to do this or that, wait for inflows, outflows, whatever. And ultimately, they might decide on something to do. But typically, they don't decide on really what to do until once we get past the month of February. So pretty much everything we're going to see in January and February has a lot to do with smaller, more immediate term flows. That can be something like options expirations, which we just had a huge options expiration day this past week on Friday. I believe that was the 19th of January, the single largest ever single stock options expiration day. And thus also we saw some giant moves in the biggest single stocks in the world, the semiconductor stocks, the Microsofts of the world, and so on and so forth. Those types of moves, however, unless they are substantiated and given the stamp of approval of new money coming in at a sustainable and increasingly large basis, tend to fade out. I can tell you over the past 25 years doing this, I have seen way too many January and Februaries. In fact, probably almost every single one of them leads to massive counter trend moves, meaning either big rallies get faded or big sell-offs, and that can happen too. You can have literally the year start, market tanks 10%, and then bounces right back in a huge way. I've seen those reversals happen way too much for me to really trust the rally here from a multi-week, maybe a couple of month perspective. That does not mean that we want to completely disrespect what's taken place. If we consider some of the moves that have taken place here over the past few weeks and continue to be verified in semiconductor stocks, it's a relentless train. But again, it's where it's happening in the year that to me is what's causing me to take a step back. In fact, if we look at semiconductor stocks, and at home people can look at this to the SMH ETF, we are once again starting to see the relative strength index get above that 70 line. That's not the only thing that matters. It's a single factor model, of course, but it is something worth taking into consideration when we look at the market through the lens of momentum. And so we're seeing a lot of stocks, even on the single stock level, Microsoft, for example, from a relative strength perspective, starting to get to the point where we want to be very careful, even forget on a daily basis, but even on a weekly basis. So this is like on a long-term, longer, and I say long-term, we're talking about multi-week perspective. That's not very long-term, is it? Get extremely stretched. So to try to answer the question, can we trust this rally? Is this rally for real? I would say let's respect seasonality. And again, I want to reiterate, seasonality is tricky. Seasonality needs to be understood what it is. A lot of people look at seasonality. They love following seasonality because it's simple. They see, every year in the month of whatever, April, this is what happens. And that's actually not really true. It really depends on where we are in the economic cycle. So those are average numbers. Just purely looking at seasonality is a very dangerous thing to do in my view. So really have a look at seasonality and understand what are the forces that are making that seasonal pattern work. So January, February, a lot of choppiness. Again, institutional investors don't really make up their mind in a big way until a bit later on typically. And then quite frankly, seasonality can remain very choppy as well, basically through the summer. So that's another thing to keep in mind as well. So we tend to see the biggest seasonal patterns from a trending perspective tend to be for equities as a whole, March and April, and then again towards the end of the year. This year, I think we have to be careful because of seasonality. And then we have a lot of choppiness, again, January, February, and then the spring tends to be choppy as well. So let's look at this a little bit more granularly and understand also what's going to take place here coming up over the next couple of weeks. We are going to start to see earnings season kick in. So what does that mean? That means we're going to start to see big companies, not just in the banking sector that have already reported earnings, but also we're going to start to see companies such as, for example, Apple and PayPal and such start to report earnings. Apple, PayPal, Microsoft, NVIDIA, all the names. PayPal doesn't really, I don't know why you mentioned PayPal, maybe because it's on my screen here. So we need to be mindful of that. So basically, we're seeing a giant rally in the Microsofts of the world, in the semiconductor world, right into their upcoming earnings report. That does not mean these stocks have to totally fall apart, but the odds of these stocks starting to stall and mean revert head either right into earnings or their earnings or through odds increase dramatically in my view. And so let's have a look at another factor that to me is probably one of the biggest warning signs here. And again, I want to make sure I'm not sounding too bearish. I'm not here to constantly be the ultra grizzly bear and doubt things. I just want to, the biggest problem that I see retail investors, self-directed investors, and quite a few institutional investors tend to do is chase charts. Chasing charts feels great when it works. One has to be quick and a little bit lucky for that to more consistently work, because we tend to see the elevator up and the escalator down, and sometimes the escalator skips like an express elevator down. What I'd like to quickly talk about is a very serious diversion that we've started to see late last week between the equity market and the bond market. And so for those of you that can see the screen, there are two lines here that I'm showing. And typically what we've seen for the past 12 months is, and this example here goes back to about the middle part of November, a strong positive correlation between the equity market and the bond market. So the bond market has basically allowed the equity market to go higher. Bond prices have gone higher, meaning bond yields have gone lower. And so if you see this chart, you will see there are two lines, blue and orange. The blue line is essentially the bond market. The orange line corresponding to that is the equity market. They tend to move in tandem, or at least have, let's just go even just back up into early November. What we started to see this week, just as we started heading into this giant options expiration, is a complete separation of those two charts, a complete break of correlation. So the equity market, not listening to the bond market, took off like a scolded donkey to the upside. And I think, to me, in large part due to the options expiration. The bond market, however, even though it saw a little bit of a bounce on Friday in terms of bond prices up, bond yields lower, it was nothing near to the equity market. This break of correlation at this point in the cycle, to me, would mean that the equity market is really getting ahead of itself. Again, I don't want to sound like a grizzly bear. These breakouts are important. I think semiconductors had an important breakout. The question is, does it have to continue at the rate at which it has, or can it just stall or maybe mean revert 5 or 10%? And I think the answer is it certainly can. So when I look at this correlation break, again, the bond market is not agreeing with what the equity market did over the past couple of days. And the bond market tends to, and I'm going to make sure this doesn't trigger too many people, but the bond market tends to be smarter than the equity market. That's not a derogatory statement to anyone that's an equity investor. It just tends to be a bit more clued in. The equity market tends to be more optimistic. It's a good thing, right? But it can also get a bit overly optimistic is the other side of that. So when we look at the equity market break away from the bond market, I really want to be careful. In fact, again, this is not a sell or short signal and dump every stock. It just means I think it further, and this bringing a full cycle, it further agrees with that seasonal pattern, that seasonal choppiness, that breakout, fake out move that we could see, or the breakdown, fake out move that we can see typically in January, February. So whatever the big move tends to be in the first part of the January, February broader move, I tend to see that one reverse. And I think we are now quite likely to see that one reverse. I think this rally more or less out of the gates. We had a few down days in the broader market. I'm just looking at Microsoft or pointing to Microsoft. I think we're going to start to see this reverse. And again, that correlation break between bonds and equities, to me, pretty much is helping us qualify that, or giving it even more higher probability that this rally here, I think, albeit from a multi-month perspective, might be trusted. I really am concerned about the near term. And again, I'm not thinking things are going to fall apart and we're going to collapse 30%, although some individual stocks certainly could. But I think this rally last week that everyone got extremely bullish on was largely led by options expiration and needs to be carefully watched. So that is how I see things here, folks. I hope this is helpful, and I hope it also helps you understand the importance of watching other asset classes, equity markets, how they correlate to the bonds, how they correlate to the dollar, right? And then, of course, we can go much more granular than that. But I think this point here of the correlation breakup between bond and equities is important to watch. So hope it's helpful, folks. Have a wonderful start to your week, and we'll speak to you again in the next Steady Wealth podcast. Thanks for listening.